Japan just told the Trump administration a firm, unapologetic no, rejecting a demand that, if accepted, could have destroyed their economy overnight. And the timing couldn't have been worse. Just as this bold decision was made, Japan's $22 billion bond auction failed spectacularly, sending ripples through global financial markets. But instead of weakening Japan's position, the chaos might actually be reinforcing their economic independence and exposing major cracks in U.S. foreign economic policy. This isn't just another diplomatic disagreement. This is the world's fourth largest economy staring down the world's largest and choosing potential instability over submission. And the consequences are already being felt. Asian currency markets are reacting. Global investors are on edge. And other nations are watching closely to see if resisting American pressure is even possible or profitable. So, what really happened? According to insiders close to the negotiations, the Trump administration pushed Japan to weaken the yen by flooding global markets with Japanese currency, a textbook case of currency manipulation. Why? A weaker yen would make Japanese exports cheaper, giving U.S. manufacturers a better chance to compete. On paper, it's economic strategy. In reality, it's a grenade tossed into the heart of Japan's domestic economy. Let's put it simply. Imagine printing fake money and dumping it into a real economy. The result? Your money becomes worthless, prices skyrocket, and citizens suffer. That's exactly what would have happened to the Japanese people. Japan imports about 60% of its food. If the yen dropped by just 20%, grocery prices would surge instantly. Everyday essentials would become unaffordable. Savings would be wiped out. And decades of economic stability would vanish overnight. Japan's answer? Absolutely not. Prime Minister Fumio Kishida's economic team reportedly refused to even entertain the idea. For them, the message was simple: we are not going to destroy our economy just to improve America's trade numbers. Now, about that bond auction. Japan attempted to sell $22 billion in government bonds, safe, long-term IOUs that normally attract investors with stable returns. But this time, it went south. Only 60% of the bonds found buyers. That's the financial equivalent of throwing a garage sale and half your best stuff sits untouched. Investors walked away signaling deep concern about Japan's fiscal direction. This failure rattled markets across Asia. The yen fell another 2% against the dollar. Stock markets in Tokyo, Seoul, and Hong Kong took a hit. Speculation rose fast. Would Japan be forced to raise interest rates? Would it spark a slowdown? But here's where things took a surprising